Everyone, we're back again today with Connor after a little summer hiatus. However, no rest for the wicked. Connor kept trading even while on vacation, and now he's up close to 70% year to date.
66.39.
Yeah, he came out of his minus 18% drawdown for it only took him about 3.5 weeks. Probably not the best thing, but we're giving Connor more tools in his tool belt. So he bring a new trade today, which is popular all around, and that is the opening range breakout. Just initially, if you kind of want to explain, Connor, how you heard of the opening range breakout, what is your understanding around it, and then what you've done to learn about it thus far.
I mean, I'm going to give credit where credit's due. I learned it from Mark. Like, we kind of have a little trader chat on our Discord with Jordy and a couple of the other guys, and Mark brought this to our attention, and I honestly never heard of opening range breakout before. So looking at the trade, it was performing really well when the trade that Mark showed me, but I couldn't explain it whatsoever. So I wanted to kind of do a deep dive. Mark sent me over to this Option Omega boot camp, and basically what I learned from the open range breakout is, let's just say that you have a breakout of 11 a.m. to 1 p.m., just keeping it simple. If your price breaks out during that time, then let's say your action is buying a call, then the action you put in there will happen. You will buy that call, and you have filters of high and filters of high and low, and that's just the price. If the price is high during that time, that's when the breakout will happen, or if it's low during that time. And that's like what I've seen. The one that I was playing with, that I was just trying to learn on, was just a simple one that I got from Options Omega, and it was a 45-30, 45 delta, 30 wide, but I kind of made some changes to it, and I did differently than what he did. I know I'm kind of going on a tangent here, but if you want me to dive into it, Mark, or do you want?
First, I'll kind of explain a little more. So, Connor, this is one of his favorite trades. So before we start this, we'll do like any proper meeting. Say, hi, my name's Connor Trolley, and I'm an orbaholic. So if you want to, introduce yourself first before we go into this in more depth.
Hello, my name is Connor, and I'm an orbaholic.
Orbaholic. There you go, baby. So the first thing, and this is what I really want to bring up to not all the backtesting people. Like, everyone always gives me grief because I never show myself live trading, but this is like the exact classic discretionary trader thing. So how the opening range breakout occurred is it's basically a classic futures trade where people will go through basically the open until 10:30, and they'll say, what is the high point, or what they would call resistance, and what is the low point of price, or what they would call support over that period of time. And they basically say, if we break the high, resistance, we're going to sell a put. If we break the low support, we're going to sell a call. So this is just showing all these people that have these rules and discretion that we're literally back testing this exact rules, and then we're automating it, and we're not using any discretion on our size, and we're trading basically a fixed lot. So that's essentially what we're doing. So to kind of explain what this trade is with Connor, is basically he has marked the high of the opening range. So basically what this would mean is the market opens at 9:30, the end of his opening range is at 10:30. So he's saying, let's say if the market opened at 6,000, we reached a high of 6,030, and we reached a low of 5,095. This is basically saying anytime after 10:30 or between 11 and 1 p.m. for basically, is a half-hour cool-off period. So if it breaks that high between 10:30 and 11, he's not going to take it. If it breaks the high after 11 and between 1 p.m., he's going to sell that put. So this is basically a signal that we've broken out from the price action. Like, this is your classic Discord person saying thing, and then we're going to mechanically manage this with stop loss. So we're basically taking this as a full bullish thing. You can see that Connor is taking a 55 delta. Connor, a 55 delta is close to the money or far out of the money?
Getting closer to the money.
Exactly. So Connor's basically selling at the current price of the market. So if we break it at 60.30, we're basically selling at 60.35. So we're selling right in the money. And he is using a low stop loss here. So it is, you can see not a very high win rate. Oftentimes with a low stop loss, we're going to have a low win rate, and that's going to lend to a higher MAR ratio. A few things here. What would you say the biggest red flag on this entire backtest is, Connor?
For me, I was having a really, and I don't know if I'm right or wrong on this, but I'm just going to tell you my personal opinion. I was having a really hard time. I didn't like a 45% win rate. I wanted to get a higher win rate than 45%. I was really trying to break into the 50s, but when I was breaking into the 50s, my capture was completely like dying. Mm-hmm. So I was like, I wanted to try to be at least above a 10% capture on this one. And I mean, we all know 10% capture not the best, but I wanted to at least be higher than that, and then around a 50% win rate.
So do you know why your capture is low? Or if you could hallucinate why you think the capture was low, what would you think it would be? I'll give you a hint. This is a pretty squiggly line. There's some big drawdowns. What do you think could have caused that?
Is it being too close? Is it close? Am I too close to the money on this one?
So you're thinking of it a little differently. So what I would so do you remember when we talked about sequence risk? Do you remember what sequence risk is?
I can't remember off the top of my head.
Okay. So sequence risk basically means you're taking on the risk of several sequences being like losses. And what we've done here is by choosing a 55 delta, you can see that the premiums can be a little wacky. So you're selling $7 here, you're selling $9 here. Watch what happens when we go to a really volatile time, like let's call it April or March. So you're taking $12 here, you're taking $13 here. So that means on Friday, March 14th, you took a $13 one contract. And then today you're only taking, or on Monday, you took one that was 1/3 the size.
Yeah.
So your sizing each day is dramatically off.
Makes sense.
So
I was wondering if my sizing was right.
Yeah. So since you're managing with the stop loss, one day you're risking $400, and another day, and we can do this too in Option Omega, where it's like if we go to losers and we can go to ascending, so you can see like $1,100 losers here, and they're very high. So you're taking $1,100 hit here, and then you can see on other days you're taking a $400 hit.
Yeah.
So that sequence of returns we're taking. So it's like you have a strategy that works, and you're using back testing, but your sizing is as random as the people that are just looking at a chart and never back
Makes
testing.
sense.
So when we're back, and this is where I see most people make the mistake in back testing. It's obvious because they don't have the knowledge. It's like they're doing all the back testing right, but garbage in, garbage out. Their input
Makes
sucks.
sense.
The other thing that comes out to me is it's like, so you draw the range at 10:30, and then you're basically saying that the trend doesn't exist between 10:30 and 11. So, I mean, I'm quickly just going to change this to kind of like, show you what I think we could do to improve it.
Yeah.
But basically, if we start the range at 10:30, we'll use the same mechanics to simplify it. And then also, like, let's just say we're selling a $5 option at that same fixed return. We'll see. So I think this will, I don't think it's going to improve our win. I think this will improve our win rate to about 50%. And then it may decrease our MAR because we may have won more in better times. Yeah. So you could see our win rate actually went down. Oh, let me marry these then, I think. Oh, $5, 25 wide. Oh, so you were buying. So So this other thing too was it's like we're going long. Okay.
Yeah. This is a long one. This is just because of the video.
I just realized that. So let me flip this around then. So this is a good signal.
I know it's weird. We usually don't go long with us, but like
but now sequence risk rise. So 11%, 25 wide. So this gave us 438. This gave us another 38 occurrences, and we ended up making the same amount of money. So not terrible, but I would say that's a little curve fitty.
Yeah.
So I don't love that, but the signal still looks good. So what I'm going to propose is, okay, so that buy call 25. Oops. Let me sell. Where's this at? Okay, let's sell a $5 call. Okay, so what I'm going to propose here is we do a Super Bowl. You ever heard of that?
No.
Okay, so
Sounds fun though.
Yeah, basically a Super Bowl would be like you are going to buy a call and sell a put simultaneously. Yep. So when we go here, we'll see how this tests. And I'll make a duplicate here and see if this improves our return. Go to portfolio.
Theory behind the buy the call and sell a put on that, because I usually understand like when we stack the buy call, sell call, the buying power, but
oh yeah, I've been doing this wrong. I've been accidentally selling a call, which obviously wouldn't be profitable. So this would be selling a put instead.
Yeah.
And this needs to be minus 50. Okay, so that'll take a second to go. Then ORB practice. Okay, so let's run this. This is super capital efficient. We're already kind of constrained with our buying power a little bit. So I'm a big fan of this. Require 2 hits for a stop loss. I'm not as concerned with that on a long trade. I would just say that, we have exit slippage, so I don't really care about the 2 hits for a stop loss. It'll be the exit slippage. So this
really didn't make much of a difference when I took it off and when I put it back on. So I was just doing it for.
So surprisingly, this doesn't work super well. What if we go $4 buy put minus 100 or minus 50? So we'll try to find a bullish one here. Go 1030. Opening high only. Let's go. Cap stop loss. So I would love to find
a bullish one to kind of.
So like the kind of reason I'm trying to make a bullish one here is, okay, so like 45% win rate, but like capture's really good. So we could see that like the average cost of one of these is roughly like $7, maybe a little more, $8, $9. So like if we could cover half that cost with selling a put, here we go. We can sell a put. We can, and we got 66% win rate. So like on the 50% of the days we lose, we're only going to use half as much.
I love that.
And then this under Connor portfolio video.
Yep.
Okay. Now, quick thing, and this is just off the top of my head. I don't know if it's going to work. So like if we go to new portfolio.
You're just going to slap both of them in there, see what it looks like.
Yeah, we'll go SPX dailies. We will go Connor portfolio videos. We go ORB. ORB practice. What did I say? I may have not refreshed. ORB practice 2. Let me go to here. Go to new portfolio. $100,000 account. Since XPX dailies. Connor portfolio practice. ORB. Okay, so we'll do a 1 lot of this one, and then we'll do a 2 lot of this one. Let's see how that goes.
Which one did you 1 lot?
I 1 lotted the long, and I 2 lotted the practice. So basically, it's like if the market doesn't move at all, we should break even. If it reverses, we'll lose twice as much. And if it trends in the same direction, we'll make more. And then we can also try this at a ratio of 1-to-1.
Yeah.
And see how that looks.
I mean, it makes sense. Our puts usually always do so much better than the calls in the market as well.
Yeah. So, and then this one will go 1-to-1. Okay, so quick look at how we do. So this is your original trade, 2.7 MAR.
Yep.
And then our result now is a 3.1 MAR. Obviously, our premium capture, this is kind of weird because it's like a calendarized structure type thing. It looks a little weirder, but you can see that this was able to improve our returns. So we have a little bit different. So like on this one, we're losing 1. On this one, we're losing 1.5x. On this one, we'll take it at 1030. This one, we won't take till 11. So we have a little bit difference in here. This one's very bullish. This one's semi-bullish. We get decay on this one. We lose from decay on this one. So basically what I want you to understand here is like, we've taken a position where we have a lot of upside.
Yeah.
But we're not really paying decay. So decay is that theta. Remember that? So like we're losing and we're decaying the value of our option because we bought an option here and we're making money on theta from here. So we've basically neutraled out that theta burn, basically.
Yeah, that makes sense.
So it doesn't have a fancy finance term is called the cost to carry. Like this doesn't really have much of a carry cost. And then if it reverses on us, we can only lose, half as much as we lose in this one. And then the 1-to-1 ratio is actually better, slightly better MAR. Yeah. And judging by our capital performance, I'd say we go with this one. Even in the age of Donald Trump, 12% return, 3% drawdown. This is looking pretty good. So Connor continued to impress me. He's printing money. Landed. So we're going to get to 100% now with this. So next question here, you've just added another trade to your over leveraged $100,000 portfolio. What size do you think we should run this at, knowing this is a one lot on a $100,000 account?
Are you talking about like what mechanics on the size? And are you talking about the 55 delta, or are you just talking about the lot? Like, should we just keep it at the one lot? Or are you saying?
Yeah. So you want to do the 1-to-1 or the 2-to-1? You make more money.
I mean, let's just start out with we know they both work, so let's just start out with the 1-to-1, and then.
That's pretty off brand of you, Connor.
I'm learning from our last. You said forward test.
People want to see roll the dice, dude. You just came out of that that 20% drawdown like it was no big deal.
You told me to forward test, man. So we're trying to forward test here. But no, I mean, I'll rip it if you want me to. But
no, I think it's better if we start this small. I think what we'll do now is we will show everyone how we make this in TradingView, how we link it to a webhook via one of the trading softwares, and then how we're automating, this type of discretionary trade, basically.
Love it. Yeah, I'm excited to see that as well.
Do you have any more questions, or if you could quickly state 3 things that you kind of learned from this call, what would they be?
I would say that I'm continuing to learn the importance of balancing out your trades by having a bearish one and a bullish one as well. And the benefits of that. I think that was the number one takeaway that I have, because sometimes I just think, I'm just going to do this long one, and I forget it'd be good you're missing out on an opportunity to capitalize on either or. If you're doing a bullish one, you need to have a bearish one because you can capitalize on that as well. 2, just understanding the price action on that one. Like if it's on the high versus the low, like, hey, if this breaks that high price point before your time, that's when you're going to take that action. I think that's when I was kind of missing the concept on the ORIB orb trade. And then 3, just understanding, again, just still understanding the size of it. Because I look at this and I'm like, let's rip it. We can continue to level the contract, but we still need to take our emotional discretion out of it and just remember, like, hey, let's just start with baby steps with the one lots, because that's how I see traders die on here all the time.
Yeah. And I mean, in all honesty, like if we die, I'll just add more money to the account and we need to make content. So we might as well rip it. Not saying that other people should do this. Talking to the guys that took like 20% drawdown a month, but it's like the only way, like our learnings surpassed our account growth. So we just have to keep ripping it.
Yeah.
So yeah, we'll do that. I think that was good. I think combining them as a Super Bowl makes sense. It's called a bull because in bull markets, the market goes up, bulls buck up. In bear markets, the market goes down. Bears slash down when they attack. Yeah. So quick history level with that. but we will get this out. If there's anything else you want to see Connor cover, or if you're interested in maybe Connor running a little boot camp on all this stuff, put some comments down and we can see maybe if we can organize something for, Connor throwing a Saturday meetup or something. And then if the Option Omega guys are watching, let's get Connor on, the morning roundtable someday here. I'll get out to him and we'll have you make a celebrity appearance on it here.